As you get to within 5 years or so of retirement, you may pay more attention to the allocation of your investment portfolio. It's a little bit like the state of our home just before guests arrive. I find that I might have been focusing on many other things, but suddenly become much more concerned that everything is put in its right place just before people come over. For many folks, they have a renewed focus on putting their financial house in order as they approach retirement. And we'll talk about how you can think about your portfolio allocation as you approach retirement today. All right, so Spencer, today we're going to be looking at how to approach retirement in terms of how do we think about the asset allocation. And oftentimes, clients have been working and saving for a long time. This doesn't seem like real money because it's off on the sidelines and they can't touch it. But now, if they need to take distributions, it goes from being sideline money to very real money that they need to spend. And oftentimes, this is actually really challenging for clients when they make that initial move from saving resources to spending resources they've saved. So as we think about asset allocation, especially as we approach retirement, and then as we get into retirement, what are the big things we need to consider?
Well, like you said, Thursday night's dinner has always come from that paycheck, and they will have a different emotional response to seeing those statements go up and down because they've never really been thinking, for most folks, that my dinner or my trip or whatever is going to be financed by taking those distributions, but now it is, and they can see that on the horizon. It's a very different emotional experience for probably 4 out of 5 clients, that we work with. So I think as we do this, one of the things that would be a basic building block is that we've got to incorporate all of the financial elements into one picture. I can't tell you the number of times that we sit down with folks and they say, well, I think that I understand about Social Security or pension or these assets that I've saved over here or what I might receive in some kind of partial work, agreement with an employer. But they haven't thought about the sum of those. So oftentimes we will find that clients have less financial pressure as they come into retirement than maybe what they were expecting. And perhaps their portfolio needs to be realigned as a result. Or perhaps they've been very, very aggressive in their investments over time, and they haven't come to grapple with the fact that in 6 months, they're going to have to start taking these distributions, and they'd prefer maybe not to have all of their portfolio going up or down, with the state of the economy and the stock market there. They want to be invested in some resources that are a little bit more defensive. So the first thing that we've got to do is we've got to bring all of those pieces into one consolidated plan. It's also not uncommon for us to sit down with folks who find different investment accounts that they had not been mentally, putting into the picture. But when they're forced again to bring everything together, then we get a much clearer picture, and we also bring a lot more confidence and rest to it because we've got all of the different pieces now talking together, and you can make decisions based on that. Whereas, prior, oftentimes we'd be forgetting a lot of different things, or our mental accounting would be off in some way.
Right. And we talk with clients sometimes that say, when we create this financial plan, I've dreamt of ideal life several times. We don't need to go through this. Just tell me what can I take out? But that's really, it misses the point because like we talked about so many times, it really is critical to align your wealth with your core values because then it allows us to really tailor a plan that's going to best suit that individual client. We can't make one plan that fits every circumstance.
Right.
And so knowing where the client wants to go, what their vision is, do they want to take a higher level distribution early and then slow down as life slows down? Do they want to pass along more resources late in life to heirs? Like there are so many things that we need to consider when we're building this plan that oftentimes aren't considered. So that's why we, in these videos, come back to this over and over and over again, because a plan is crucial. Knowing your goals is really crucial. So walk us through kind of this idea of asset allocation. We've walked through it in other videos, but give us just a broad overview of how we want to think about it, especially as we're getting closer to retirement. What are the risks involved of not doing that?
Well, and we'll put in the show notes a link to the other presentations that we've done with respect to these different asset classes that you could do a deeper dive here. But generally speaking, we need to say, what's the money for? And if the money is for a distribution in the next few years, we need to typically be more conservative with those funds. If the money is for a distribution that might be 20 years down the road, we can be more growth oriented because typically those investments are going to go up and down a bit more, but they're going to land 20 years down the road at a higher point than maybe some of our more conservative investments, if history is any guide. So again, we want to understand the key difference in asset classes. So if we break this down, equity and fixed income. So equity investments, you are owning a part of a publicly traded stock, typically. You're owning a part of that company. And so as an owner, you participate as that company grows its revenue, grows its profitability, grows its stock price. That stock price oftentimes, again, if history is any guide, it's going to be up and down quite a bit more than, say, a fixed income rate of return, a bond rate of return. But the rate of return over long periods of time has tended to be nice. It's, if we look back the last 100 years in the U.S. stock market, the U.S. stocks as a whole have done nicely relative to their bond counterparts in most periods there. So we want to understand that on the stock side, the equity side of things, we're going for growth, but we also have to embrace the fact that there's going to be more volatility if history is any guide. On the opposite side of things, we need to know that on the fixed income side of things, U.S. government bonds, corporate bonds, other types of fixed income, that the rate of return over long periods of time has not tended to be quite as high, but those rates of return have not been as volatile. So if we're thinking of taking a distribution in the next 3, 5, 7 years, those bonds are going to be much more likely to be about where they're at right now, having maybe provided some interest, rather than stocks, which could have performed really, really well over the next 3 years or terribly over the next 3 years, but all driven by the profitability, by the value of the stock price of those companies at that time when you need to sell. So we need to understand the difference in that asset class, those two in particular, because they both have strengths. They also both have limitations. And so we need to create a plan that looks at the level of distribution that a client has and soberly says, okay, how much up and down can you take? How much do you need to take sometimes to be able to achieve those financial goals?
Right. And I think sometimes what we wrestle with clients is you may have the emotional capacity to take on extra risk, but your plan may not have the capacity to take on extra risk. And so we have to be a neutral, emotionless third party with our client's money to say, hey, I understand that you want to be more growth oriented. However, with what you're doing, we really need to be more fixed income oriented here because we can see a greater picture there. And so it's really matching both what is your tolerance for risk as well as your capacity to take on risk.
Right, because if we have clients who are, say, 60 years old and we recognize they're going to have tremendous Social Security at age 70, they've got 10 years worth of distributions. The next 10 years, we don't want maybe nearly as much of those resources to be in stocks if the distribution has to be very systematic and really can't bear those ups and downs. Now, of course, we'll lay out the facts and clients make the decision, but oftentimes what we find is that we need to match those liabilities that are coming in, that is the distributions that are going to be taken out to achieve that lifestyle, and we need to match that to the asset allocation.
Yeah. So you want to walk us through like the last 25 years or so of history and why this is important to think about?
Well, in the last 25 years, we've had two periods where the U.S. stock market as a whole dropped by 50% or more, and it took some time for recovery. So this would be, again, that trifecta of events that happened from 2000 to 2002, but we had the technology bubble bursting, we had 9/11, we had the Enron and WorldCom accounting scandals. So the stock market as a whole in the US dropped almost 50% as a result of that, and took about 6 years from one peak to come back to that next peak, there from 2000 to 2006. So quite some time. We, as Warren Buffett would often say, the first rule of investing is don't lose money. Second rule is don't forget the first rule. We don't want to be put in a situation where we have to sell stocks, sell equity investments when they've just taken it on the chin. The only market in the entire world where you can see something go on sale and people run for the exits is the stock market. So we could see a drop of 20%, 30%, 40%. We don't want to be selling into that. If anything, we want to be buying into that, or at least be neutral
Right.
They're not having to pull resources out. So that's the value of an asset allocation plan, is being diversified enough and really knowing where your distributions are coming over the intermediate term and short term, and having things structured accordingly.
Right. And for clients that are in their early 60s, that could be 5 or 6 times over the course of their retirement. We could see those big drops and then the recovery that takes 5 or 6 years several times in the course of the entire time they're taking distributions.
Well, and to your point there, again, we've seen it twice in the last 25 years. It talked about the drop from the technology bubble bursting, but we saw it again in 2007 to 2009. The U.S. stock market, the S&P 500 index, dropped, I think, 57% from peak to trough.
Mm-hmm.
So again, not putting too much of an emphasis on this, but if you had $1 million invested in U.S. stocks in the S&P 500 at the peak there in October of 2007, by March of 2009, your investment has dropped to less than $500,000, to about $430,000.
Mm-hmm.
If you're invested and you're somehow able to replicate the index there. So it is something to be really, really sober about how much you have in stocks. Now, the flip side is, of course, stocks give us a nice rate of return if history is any guide, and a better rate of return over long periods of time than bonds. But it took, again, over 5 years from the peak there in October of 2007 down through the trough in March of 2009, all the way back, later in 2012,
mm-hmm.
to get back up to that all-time high there for the U.S. stock market. So twice in the last 25 years, we've seen a recovery that took 5.5, 6 years.
Mm-hmm.
So we want to make sure that we've got enough, typically in fixed income, to be able to deal with the ups and downs in the market. Another great example would be, what happened in the COVID lockdown.
Mm-hmm.
We saw U.S. stocks drop by about 1/3
mm-hmm.
in 30 days.
Yeah.
So we wanted to make sure that we could sell from, say, U.S. Treasury bonds
mm-hmm.
that did not have that same experience, that basically, for the most part, held their value in the midst of that, and sometimes, in some circumstances, even bumped up a little bit in value. We want to have different places that you can take distributions from as you approach retirement. But that's not always true, as people, they may have been saving for 25 years, and they get to close to retirement and they say, oh, where am I?
Mm-hmm.
Do I have enough in these different vehicles? I need to really take stock of where I am.
Right. And so oftentimes, if we have enough runway with a client,
mm-hmm.
they say, hey, I'm thinking about retiring in 4 to 5 years. We look at their portfolio. It's incredibly growth oriented. These are questions that we start asking of, hey, how many years of fixed income distributions do you need? Are you going to start taking distributions from this account immediately? If so, if you're 100% stock focused right now, let's work with you maybe to start getting a little bit more conservative.
Mm-hmm.
Now, again, this comes in concert of an entire financial plan. If they're not going to touch these resources for another 20 years, then it's a different story. And so we can't say for everyone, if you're 5 years from retirement, let's start coming more fixed income oriented. It all depends on that plan, where your resources are allocated. So talk us through, as we think about different account types, different distribution schedules, when we think about the broad asset allocation, what questions are we asking for clients?
Well, it all comes back to, again, distributions. And one of the things about distributions that's interesting, because sometimes, as we've had in our couple of examples here, we will have clients that have been very, very growth oriented, very aggressive in their investments, and we need to be more conservative. Sometimes, though, we'll have clients that they don't think that they're going to work to age 70, for instance, or into their 70s. They think that they'll retire earlier, but they're just having fun and they continue to work. And so we update their financial plan over time, but they may get to age 70 and they've got Social Security coming in, they've got pension, and they say, okay, I was more conservative with my investments. Now I have more latitude, more flexibility. So it can actually mean that as we update their financial plan, they can become more aggressive.
Mm-hmm.
As we joke with them, they can get greedy for the grandkids, that they're going to pass on more, maybe if they're more aggressive. So it can go both ways, really, as we think about the different pieces. When we think about particular account types, though, now we layer on an additional level of complexity.
Mm-hmm.
Because if we are looking at a client set of resources and financial plan, and let's just say they have significant non-qualified resources, those would be after-tax resources, but they're invested in stocks and there's some gain in those. Oftentimes, if they're in the last couple of years of their working career, they may be at peak earnings, and we don't necessarily want to reposition those to be more conservative because we're going to incur long-term capital gains and the tax that goes with that. So we want to be really careful as we think about which accounts we rebalance. For a traditional IRA, for instance, it's much easier, or a traditional 401k, it's much easier to rebalance that account. We might be going from a posture of more growth-oriented to more fixed income-oriented, or just rebalancing a bit there. And that's not going to cost us anything from a tax standpoint. The other thing that sometimes clients are surprised with if we do initial financial planning is that we may actually increase the allocation to growth-oriented investments in their Roth 401k, their Roth IRA, again, with the idea that the more growth that we can get there over long periods of time, you're not going to pay tax on that if you take out qualified distributions. So oftentimes, if we sit down with a client and they're approaching retirement within the next couple of years, we might actually see their Roth allocation, their Roth investments become more aggressive. We might see their traditional IRA or traditional 401k adjusted based on their financial plan, and oftentimes that might be getting a little bit more conservative. And then their non-qualified resources, they could be more conservative, more aggressive, just depends on when are we going to see those distributions taken out. Now, a financial planning textbook would say all other things equal, we're going to tap into those non-qualified resources first. The traditional IRA, the pre-tax IRA or pre-tax 401k, that we would probably tap into those next, and then the Roth resources last. But we've also got to overlay that with what's going on with other kinds of income and what the tax situation of the U.S. federal government might be, all these kinds of other things to be able to say, okay, this is the first lever that we want to pull for distributions, this is the second, so on and so forth.
All right, so Spencer, we've talked about just the general, we need to make sure that we have a plan in place. We need to have an understanding of where distributions are coming from, which accounts they are, what's the tax situation, what are the ramifications of moving those things around. So let's talk about, for clients that decide, okay, I do need to become more conservative, I do want to become more aggressive. How do we then build a plan to align their wealth with their core values there?
Well, let's think about it this way. We know where we are right now. We know where we want to be. There's a lot of different paths to get there. So what we want to do is craft that plan to say, this is going to be the most efficient way to get from point A to point B. Again, we could be at point A and we have $300,000 in fixed income, and point B, within a couple of years, we want to make sure that we've got $500,000 in fixed income. Now, there's so many different ways that we could go about moving from point A to point B, but it could be that we do a stair-step version of that, where we've got 4 years. Let's say we know we've got to move $200,000 in that direction. It could be that we're moving $50,000 a year in that direction. Let's just say that they have a really healthy contribution to traditional 401k, and that they have a nice employer match, and that accounts for about $40,000, of what they need. We might just be saying, hey, all new contributions go to fixed income for your traditional 401k, and then you're building up a little bit of extra there in, say, your bank account. That could be one way that we go. For other folks that maybe don't have that same capacity, they're not saving at that same clip, maybe they're paying off their mortgage at an elevated rate, and they are paying for college education, so they're not saving that much to the 401k in this season of life as they approach retirement. It could mean that we need to realign the 401k, and we could do that on a quarterly basis, on an annual basis, or we could do it in a one fell swoop type of situation. So you think about that again, we've got a path from A to B, and it could be that we're stair-stepping that, where we're adding, again, something like $12,000 on a quarter-to-quarter basis, over a 4-year time frame, and we're just rebalancing a traditional 401k a little bit every quarter. Or it could be that we say, okay, well, everything else looks solid in the financial plan. You could rebalance and do all of it now. So you could say, okay, it could be that you move from $300,000 up to $500,000 day one. Right. And so now you've got that path, and we might back off on that just a little bit. It might be adding another $180,000 with the idea that they're going to have some interest income over the next few years or whatever it might be. But we get there basically on the front end of things. Or we could have clients that they're very aggressive and they say, I want to defer that upstep there of my fixed income allocation to later. And so we might do a very modest amount for the first few years, and they may be comfortable with a much more aggressive portfolio until they get to retirement. And then the plan might be, well, when I get to retirement, I'm going to find a good moment that I think at least to step up the amount from fixed income from $300,000 to $500,000. That would be the least comforting way maybe to go for a lot of folks, because they're betting on the market to be at a good point for that rebalance. Again, you don't want to rebalance from stocks to bonds when the stock market has just dropped 50%. So again, ideally, we craft a plan that a client is comfortable with the pace of moving over, be that at the start, be that along the way, and that we also unpack the trade-offs that they may face in that.
And Spencer, I think as we close this out, the thing that we need to come back to is whatever path you choose, you have to understand that there are going to be trade-offs in each of those. If you decide to do it right now, there could be more growth. If you decide to stair step, we don't know where the market heads, it could drop. If you decide to wait till that cliff, well, we don't know what's going to happen in 18 months, a year, 2 years, 10 years. And so if you're waiting for that cliff, you may wait and wait and wait, and the market may drop on you. So this is really critical, why we always come back to the plan, why we always come back to, let's think about this comprehensively. And so clients, if you're watching this and want to talk with us about how do you make that plan for distributions in retirement, we would love to talk with you. As always, don't take any of this and go run with it. Bring it to your financial advisor. Have a conversation with them about what does this next season of life look like for you. And with that, we hope you enjoyed this video. Feel free to leave comments below, questions that you may have, and we will see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.